All right, Ryan, I thought a great place to start the conversation is the stock market is down almost 10% to start the year. People obviously freaking out. You seem to think, hey, maybe this is normal. Maybe we just get these drawdowns, every year and stocks are going to recover. Is that the general sense?
Yeah, first of all, thanks for having me back. And I've had a little bit of a cold, so we'll see if we can get through this, on top of the market doing what it's doing. But the reality is, yes, the S&P 500 was down about 9% from the late January peak until just recently. But then you look, Anthony, and the average year pulls back 14%. Last year, right now, we actually went into a market correction last March. You might remember why? Liberation Day was in April, right? I mean, it's because we were worried about DeepSeek and volatility. So by no means are we minimizing what's going on out there. But after the run that we've had, I think by the way, it's a midterm year. Historically, those are usually the most volatile, as lots of people have been saying, including myself. I'm a little surprised with the weakness that we've had. But then again, you look at the headlines, and it's like if you looked at the headlines, you'd almost be more surprised. Well, not down more. Maybe crude oil should have been up more than it was. It's a very unique situation, but I think you need to remember volatility is the toll we pay to invest. And most years, on average, do see at least a 10% peak to trough correction. We're not quite there yet. Who knows? Maybe by the time people listen to this, we will be. But I'm not so sure this is so abnormal as of yet.
Now, a big reason why this drawdown happened is because we went up for like 9 months straight. And so people kind of forget that you're just giving back some gains that you already got, right? It's not like this is net new capital that's being destroyed. Is that a way to look at it?
Exactly. The Dow, I think, is up like 10 months in a row. Actually, now it's going to be down in March. And the S&P 500 is up 9 months in a row on a total return basis. That's not surprising. Those are one of the longest streaks we've ever seen. And you talk about markets and it's the volatility and all that stuff. One thing that gets me, though, if you look at since the war started, yes, listen, stocks are lower on the whole. We get that. Earnings on the S&P 500, Anthony, the last month, forward estimates 12 months out, are up 2.7%. Okay. I mean, that's a big jump in what expected earnings are supposed to be. Profit margins just hit 15%, the highest number ever as well. And most of the jumps we've seen have come from technology, but all 11 sectors, forward 12 months guidance the last 4 weeks since all this stuff started, have actually increased. So there's lots of ways to slice and dice it. And I get it. A lot of people say, well, the market's still down. I get it. Yes, the market is still down. But 3 months ago, we could have said, if you're worried about anything this year, maybe some valuations are a tad stretched. That is not the case anymore. Stocks have pulled back and earnings have remained strong, which hopefully should help calm longer-term investors.
I recently did this big study, if you will, a research, and I wrote this piece about software stocks in particular. And basically, I wanted to challenge myself to go write the bull case for the software stocks. So I know everyone is bearish and worried about AI and the seat compression and all this stuff. But one of the things I found interesting is Wall Street analyst consensus on the Microsofts, the Salesforces, the Adobes. These things are like 50 to 150% appreciation from where we currently are. So the analyst, now whether you agree with them or you don't, whole different subject, but if you do think that they've got some good work that they're putting together, they are all believing that these stocks have a lot of room to run, which seems different, counter to kind of the retail sentiment we're seeing in the market.
No, you're right. And there's no question when you get into with AI and destruction we've seen, specifically in the software names and the SaaS names. I mean, some of those companies are in trouble. I think they've thrown the baby out with the bathwater, though. I mean, again, a year ago right now, we're talking about DeepSeek, and no one's going to invest in AI anymore. It's almost laughable, what we've over the past year with the continued AI rollouts that we've seen. We manage a lot of money at the Carson team, and we actually added a little bit of software ETF. At this point, maybe 4 or 5 weeks ago, again, on the realization that software stocks are as cheap as they've been since 2014. Now, I've done this a long time. You've done this a long time. Sometimes things are cheap for a reason. I'm aware of that. But again, for longer term investors that are willing to look out a year to two, I mean, listen, these are some names that maybe you loved this time 6 months ago when tech peaked right around Halloween last year on a relative basis. Obviously, it's lagged since then. There are some really nice valuations, and there's still some strong moats and still some strong reasons to think. I think we just looked, Microsoft's down 35%, right, from its peak. I mean, listen, it's happened before. It might happen again, but that's a company that still makes a lot of money. And we think a year from now, people are going to look back and realize this was probably more of an opportunity not to panic, but maybe to dip your toe in and buy some solid companies on the cheap.
Now, we've seen oil's price go up. We've seen energy prices go up. Gas just crossed over $4 on average in the United States. I think there's a lot of people who are worried about the short-term inflationary fears coming from those higher gas prices. How are you guys talking to clients about that?
No, you're right there. I know one thing about Carson at the start of this year. I work with a real smart guy named Sonny Varghese on our team, our chief macro strategist. He looked at something like core PCE, the Fed's favorite measure of inflation, 178 components to that. And what we noticed, we're actually seeing inflation broadening out a little bit, right? Now, it doesn't mean inflation is going to soar to 9%. We don't think that. But we said maybe we have a tad more inflation problem than what the market is kind of pricing in. And then you look at what just happened with oil. Listen, that has obviously kind of been the cherry on top. But I know you and I have talked about this. What we've done, yes, we're overweight equities. We probably have about 68 to 69% equities. Now, in that bucket, it's not like we're all in tech names. We've got a wide moat there, or wide dispersion. But in the other stuff, right? We say diversify your diversifiers. We're not just in bonds. We thought yields would probably go a little bit higher this year. They've gone higher than we expected, but we've shortened our duration. We've owned gold. We've owned commodities. We've owned hard assets. We've had some managed futures, which have done really well this year. So again, in this more, we would call it not necessarily a high inflation world, but a volatile inflation world regime that we're in. It can go up a little lot and then come back down a lot. You probably want to own some things if you drop it, hit your foot and it hurts in that type of environment. And that's obviously, listen, when you're over at equities, this has not been a fun go of things, but at the same time, our other bucket have done really, really well being diversified like that.
Now, one of the things I think people going into this, if you said, hey, we're going to go and we're going to bomb Iran, there's going to be this global war, there's going to be a bunch of issues, the strait's going to get closed, oil's going to spike over $100, people would have said, great, I'm going to go, I'm going to buy some gold, I'm going to go and I'm going to get some bonds, and I'm going to go kind of play the geopolitical conflict, insulation portfolio. Those things basically did the exact opposite of what we expected. So what does that tell us?
Yeah, if it's obvious, it's obviously wrong. Is an old saying that I think is we've seen. Now, listen, what do we know? I mean, listen, this time 5 weeks ago, 6 weeks ago, the Fed was going to cut a couple times. That was widely expected. Now, if you look at like Fed fund futures and options things, the chance of a potential hike are actually higher now than a cut. So that's kind of it's kind of pressured high yields, and it's real yields, sorry. And that's actually put the kibosh on what we've seen with gold going so high. But the reality, again, gold's still up on the year. I mean, gold was up 60 something percent, 67 or 68% last year, about 30% the year before, up 20% or so until early January. So listen, it was due for some type of pullback like that. But I think, again, the reality is most of these commodities, in our opinion, are still in an overall structural bull market. There's reasons to think that. I mean, one thing we talked before in our shop a lot, I was out there saying, I bet crude oil has a pretty good year this year, not because of some fundamental reason, all this stuff. I think it's a global bull market that we're seeing in commodities, or I should say a commodity bull market. I don't like to use the word super cycle, but all these other commodities way up here, gold is way down here. Every time we looked, I'm sorry, crude oil is way down here, around 65, $70 a barrel. So this is probably going to play catch up. And boy, oh boy, has it ever. But you look at what crude oil and a lot of those stocks have done. I mean, clearly they've been amazing. It's been amazing. XLE's up like, what, 40% or so for the year. Now, the other side to this is one tweet, one resolution. What's going to happen, right? They're potentially going to come back. I'm not saying just as fast, but they're going to come back quickly. Why I still think in this world we're in now, to have more of that diversified portfolio, not just go all in one particular area, one particular sector or anything, to have some, you're kind of diversified. That bucket is really the way you want to be when you have a lot of doubt out there like we do.
Now, what are you worried about right now? Obviously, you're very optimistic. I think so am I. People are saying, hey, wait a second. If I like these stocks, they're lower in price, and so I should be more excited about buying them. But it tells me if there's a lot of volatility, there's probably things that you're watching or concerned about.
Yeah, what do they say? The stock market's the only place things go on sale, but everyone runs out of the store screaming. I mean, like people love these stocks 3 or 4 months ago. Now they're down 30 to 50%, give or take, and now nobody wants to touch them. Our worries aren't all that different probably than a lot of other people. I mean, if the issues in the Middle East continue and crude oil spikes to $150 or $200, not our base case, I'll be very, very clear, that is going to be an issue. But as someone who manages money and works with financial advisors, works with clients every day, I get to travel the country and talk to clients, and people are very, very worried out there. They see the headlines, they see all the negativity, they see the terrible stuff that's happening out there. And it's not the same. I don't want to say it's the same, but it reminds me a lot of Liberation Day. You and I did this a year ago, and we said, listen, there's probably more of an opportunity after that near 10.5% drop in 2 days, a near bear market that we had. And everyone gets all bared up, and they can't sell fast enough. And then you look up, and the market rips higher, right? History don't repeat itself, and often rhymes. Mark Twain. All this negativity. I saw a cool stat this morning that had to look at Goldman Sachs data, Prime Book. hedge funds have sold more the last 6 weeks in line with the 100-year pandemic and right after Liberation Day. We're down like 9% on the S&P 500. So there's a lot of hedging out there. One of the fascinating things to me, this is kind of like what the frog in the water and the water boils. This market's not going down a lot. I know it's down. I get it. But all the headlines and stuff, we're down 9%. I mean, Anthony, it took us over almost 2 months to go from the all-time high to down 5% on the S&P 500. I just did some data on that. You look at the last 11 bear markets going back to 1950. You usually are down 5% really fast, like in a couple weeks. This one took 7 weeks to do that. The reality is if we go into a bear market, that's not consistent because usually the weakness starts early. This has been kind of slow and steady. And I get what's going on out there, but when you stack all of it together, it feels awfully one-sided. It reminds me a lot of last year, and you just need some good news. That ball's under the water a long way. Get some good news. We still have a target in the S&P 500 to low double-digit returns this year. And I know it's a long way away, but we also were a long way away last year, and we did come back, and we think that'll happen again.
What about the Federal Reserve? Obviously, people, including myself, were advocating for them to cut interest rates. Now we get some short-term inflationary pressures. Maybe, hey, wait a second here. That could be, fuel to the fire. But at the same time, we are having this structural kind of deflationary forces that seem to be hitting the U.S. economy. It's a head scratcher. It's a little bit difficult. What do you think?
It is. I mean, the Fed's in a hard spot. I mean, listen, and then you hear Powell said, he did the Wolf of Wall Street. I'm not going anywhere. He gave that speech where he's not going anywhere now. So who knows when we're going to have new leadership at the Fed? And again, those widely assume that you see some cuts. I think the Fed's just on pause. I think the Fed is just on pause. They've said it before with all the stuff swirling and everything going on. I don't think the Fed is nearly as hawkish as what the markets do what they do. They sway one way and they sway the other. I'm not so sure we're going to get a hike this year. In fact, we don't think we're going to get a hike this year. I think the Fed is probably just on pause for a while, and then things calm down, and maybe we can get back to some cuts. I mean, the reality is, inflation's running right around 3%. If you look at the data, I know trueflation's one thing, and all the different things, shelter's disinflationary. We get all that. I mean, the labor market, I think, is probably a little more important. I know that the Fed is a dual mandate. I get that. But the labor market, it's shown some cracks, and I think the labor market weakens even a little bit more. That opens the door clearly for the Fed to become a little bit more dovish. But I just think the Fed's on pause until we get a little more clarity out there.
Now, the U.S. government, obviously, if we're dropping bombs, we're going to be spending money. And then we've got a midterm. And, if he's the president, then he's probably going to try to make sure you get some money in your pocket so you feel good going into the voting booth. What does that do to the economy?
Yeah, the reality, you look at, I see the same stuff as everybody else. People don't feel very good. We just had another low consumer confidence level. Now, listen, consumer confidence has been very low for years, yet the market keeps going higher. So we get that. But it is a midterm year, and it's just hard for me to think that this conflict in the Middle East will continue, well into the summer months. Again, your average midterm year sees a peak to trough correction about 17.5%. So, okay, what's that mean? Well, 1 year off the low, and I get it, Anthony, no one knows when the low is. This is the way this works. But then if you take the low of a midterm year and go out 1 year, the S&P 500 has never been lower going back to World War II, up over 32% on average off those midterm lows. Historically, midterms bottom around August. I think we're going to bottom a little earlier this year, to be honest. But those are some things to think about from an investment's point of view. But you're exactly right. There's so much politics and so much policy. And listen, I hate to get political. What happens in midterm years? I'll just state the facts, everybody. The party that wins the election tends to lose 29 seats, right? That's how this tends to work. So Republicans probably lose the House. I know the Senate's a coin flip, maybe get some resolution in the Middle East sooner or later. That means the Republicans can probably keep the Senate. That's called a divided Congress. All I want the listeners to know is this. Last 13 years, we've had a divided Congress. Stock market went up. I think gridlock is good. I think you don't want too much red wave here, blue wave there. You want some checks and balances, and you want your government to work together. And I get it. That is a real problem that we have going on right now. But just as we get closer to this midterm year, if we get a split Congress, that's usually a pretty good thing. And maybe the stock market will sniff that out.
What are clients saying? Are they calling, freaking out, saying, Ryan, save me? Or are they pretty chill and they're saying, look, I've been here before. I know that we're going to have volatility. You tell me it all the time. And, we're all good. Don't worry about it.
Yeah, it's more the latter. Honestly, it's more the latter. I mean, listen, when people are worried about what's going on, and politics play a huge part of this. Maybe they don't like who's in the White House, or they love who's in the White House, and you have the extremes either way. But when it comes to investing, I think at least Carson Group, we've done a pretty good job explaining that, again, volatility is a toll we pay to invest. Your average year sees a 14% peak to trough correction. You see even more in midterm years, and then it happens, right? The Mike Tyson quote: "Everybody's got a plan till you get punched in the face," and then everyone, oh yeah, we'll see a 10% correction this year, and then it happens, and then it feels very uncomfortable because you look at all the tech names that are down like they are, financials that are down like they are, and if you're heavy in those areas, you're going to feel a certain way that maybe someone with a diversified portfolio is not. But the reality, I think, is a lot of investors have done this for a while. We've been through before. We're not crazy about the headlines. We're not crazy about what's happening. But you look at the major geopolitical events we've had in our country, honestly, in our globe, and how the S&P 500 does 1 month later. We look like over 40 of them, Anthony. You're down on average a month later. You're about flat 3 months later. Okay, well, that's kind of where we are right now, at least 1 month later, clearly lower. But then you get through this, and the market has a funny way of being a forward-looking mechanism. It prices things in. Good. It's not about good or bad. It's about better or worse when it comes to investing. Something we've really been stressing to our clients a lot lately. And again, we were a little maybe glass half full by nature, but we think we're going to get some better news, and the market's priced in just terrible stuff out there. And we saw that last year, and we think, again, maybe the upward bias can continue.
Now, when we think about what's happening in the economy, everyone immediately goes to oil prices, conflict, etc. One of the aspects that I think is still seems to be chugging along is artificial intelligence, and it's deflationary for sure. But I do think that people are starting to use AI in their investment process. So, what are you guys doing internally? Are you guys starting to use these tools to better understand the market or come to conclusions into how to allocate capital?
Yeah, we are. We're like a lot of places. I think if you're not looking into it, not leveraging it in a big way, you're going to get left behind. I don't care what industry you're in. Yeah, I'm in financial services, but we have more than 500 financial advisors all around the United States. I think we're in 43, maybe 44 states now. I'm close to signing some more deals. That's why I'm not 100% sure there. But we've been leveraging AI a lot to give our financial advisors more power and more ability to do things. We did some data that our financial advisors can work with like 16% more clients, and they don't have to do anything extra because they're leveraging AI. We've got different chatbots and things that we're using. So I think, that's the world we're in, and then the other side of everybody's freaking out because, okay, well, if you have a chatbot that can literally do your taxes for you, do you need taxes? Do you need this? I think it's going to come down to people still want to work with people. People still want to trust people, but you can leverage this on top of it. What Jensen said many years ago or a couple of years ago, you're not going to lose your job to someone, or you're not going to lose your job to AI. You're going to lose your job to someone who's leveraging AI. So we have really spent a lot of money in terms of our overall, budget, in terms of technology and leveraging our financial advisors with a lot of AI. Just easy things, simple things like, okay, what's so-and-so's birthday and when's their daughter this and that. And you put all these things in and it gives you this information. So you remember last time you met with them, there's all the notes. The AI is doing all the notes. AI is doing a lot of different things to make life easier for financial advisors to help, at the end of the day, help their clients, work with their clients, and kind of be there like we are now when we really need to be there.
Makes sense to me. Ryan, thank you for your time. Where can we send people to find you on the internet?
I'm a few places. Let's see. The easiest is probably on Twitter or X, whatever we're going to call it, at Ryan Dietrich. And then our podcast is called Facts versus Feelings. Soto and I literally just recorded it before you and I did this, a weekly podcast called Facts versus Feelings. Those are the two easiest places, probably.
Amazing. All right. Thanks for taking the time to do it. We'll do it again soon.
No, I appreciate it. Thank you, Anthony.